I think gold will see, obviously over 3,000 this year. I don't like to make massive, wild projections. 3,200 would not surprise me whatsoever. I think silver mid-30s, maybe a chance it could reach 40 this year. I mean, silver has lagged so far behind along with platinum for years now. Right now, I like silver and platinum better than like gold, but I do like gold. But I think that they've lagged the markets for so long that there's going to be some bigger demand for those products as well. But I'm a big fan of metals in here. I think that they go higher. Listen, there'll be some sell-offs. Again, nothing's going to go straight up, just like things don't go straight down. Again, I think gold will see, let's say 3,200, if not higher. I think silver will see, 35 to 40. And I think platinum will get back into the $1,400 range. And I think that those are great places to put money right now, especially with what's going on across the globe.
Gold is expected to rise above $3,000 this year, potentially reaching $3,100 to $3,200. While silver could hit $35 to $40, and platinum may climb to $1,300 to $1,400. These metals are seen as substantial investment opportunities despite market fluctuations, particularly given global economic conditions. Silver and platinum, having lagged behind gold for years, are anticipated to see increased demand and stronger performance. Todd Bubba Horwitz, a seasoned market expert and trader, highlights that silver and platinum are seen as poor man's gold, offering affordable options for investors. If economic conditions worsen, gold and silver could be used as currency again, with smaller denominations becoming essential. There's speculation about a return to the gold and silver standard, particularly under leadership favoring such policies. Additionally, support for Bitcoin could disrupt the central banking system, exposing flaws in the Federal Reserve, which critics argue primarily serves banking interests. This shift could significantly shake up the financial system, especially with a gold advocate as Treasury Secretary. Depending on how Trump handles his first 100 days, there's a real possibility of moving to a gold-backed system. While middle-class Americans may face short-term pain due to cleaning up previous economic issues, success in passing key policies could pave the way for a gold-backed currency, countering BRICS nations and stabilizing the system. Todd exposes that banks are heavily over-leveraged, benefiting from rate spreads created by Federal Reserve policies. However, looming credit card and loan repayments could expose significant risks. A future financial meltdown will likely be tied to the banking sector, potentially leading to another taxpayer-funded bailout. Watch the video for more details and don't forget to like and subscribe for updates.
I think that you'll get some demand from there, and I do believe that you'll see money flow there because that would be considered the poor man's gold, the poor man's, silver and platinum, especially silver. I mean, and listen, if I'm right, and I do believe there's a chance that things get bad enough that we could see currency, gold be used as a currency again, gold and silver. And you're going to need some of the smaller denomination if that actually becomes the case. Now, Besant, Trump's financial guy, I mean, there's a chance we go back on the gold and the silver standard. So, there's a lot of things that are in the works because they're also very big fans of Bitcoin. And that would help maybe destroy the central banking system altogether, because the bottom line is Ron Paul was right all along, and the Fed, or at least audit them. I mean, all they really do, listen, they're owned by the banks, they're owned by the cartel, and the cartel is in it for themselves. Hence, you can watch at the 10-year notes versus the cut in rates over the last 3 months. I think there is a real possibility. Again, I don't know if we'll get there, but I think there's a real possibility that exists that we could get there. And again, I think it's going to depend, first of all, on the way that Trump handles this initial opening of his first 100 days, as I like to say. There's a lot of things that can go on. And again, I think there's going to be a lot of pain for middle class America, not because he's doing it, it's because he's cleaning up the mess that was left before. And the mess is still going to create some pain for all of us. If he gets things the way that he wants to get them done, and he gets the bills passed and he gets everything done, I think that it opens up the chance for going back on a backed currency, and it takes away all these BRICS nations, all these thoughts of other things going around. And I do believe that it has a very real possibility of happening. Credit card bills start to come due and all these loans start to come due. Again, they did get a big benefit from the Federal Reserve because they got a raise of 100 basis points on their borrowing power, and they got another 120 basis point on their lending power. So they picked up 2 points on the spread. But I think that they're dramatically over leveraged. And I think that's part of the backing behind all these cuts as well. I think that there's big trouble. And I think when we do have this meltdown that I am looking for, it will come directly correlated to the banks. And unfortunately, we, the American people, will probably have to bail them out once again.
Todd explains that the markets don't appear to be in immediate danger. Current selling is driven by light volume rather than panic, as indicated by a relatively low volatility index of 19. A significant long-term market correction of 50 to 70% is expected, but the current dip seems more natural, possibly influenced by tax deferral strategies. The overinflated money supply fuels market investments despite rising inflation and other challenges. Moreover, Todd discusses how the Federal Reserve's rate cuts, intended to stimulate inflation, have instead raised borrowing costs, with 10-year yields rising from 3.5% to over 4.7% since September 18th. This policy appears to fuel inflation as a hidden tax, increasing government tax revenue through higher-priced goods and services. Ultimately, these actions disproportionately harm the middle class. Todd also discusses that the job market is weak, with reports relying on the U3 metric, which excludes those who've stopped job searching. The U6 metric paints a much grimmer picture. Job numbers are likely to be revised downward, as many roles are temporary or tied to specific events like disaster recovery. The economy is in a recession, masked by consumer spending fueled by credit cards with high interest rates, creating unsustainable debt. Real stable jobs remain scarce despite optimistic reports. Meanwhile, the Ukraine war is expected to end, reducing U.S. spending on foreign aid. Concerns about immigration costs, including criminal activity and mass deportations, highlight the need for stricter border control, including rebuilding the wall. The speaker advocates prioritizing American interests, focusing on supporting veterans, unemployed citizens, and domestic needs rather than funding foreign nations. They support tariffs, viewing them as beneficial for the U.S. economy in the long term. Now, let's get back to the interview.
Again, I don't think that the markets are under any danger. Now, I do believe over the long term, there's a big sell-off coming, a big haircut, which I've said all along, which is I think will be 50 to 70%. However, I think this is more selling on light volume. It doesn't appear to be a lot of panic coming into the market. I mean, with the volatility index only at 19. I mean, last time we had a big dip, it was over 25. So to me, this is more natural selling. Maybe some people that were waiting and to sell till after the year so they can defer their taxes. There's a whole bunch of reasons of why. Right now, I mean, listen, I think we're in trouble. Inflation is on the rise. There's a lot of things going on, but we still have an overinflated money supply, which will continue to provide those that are investing with money to buy into this market. Well, the Fed is a bunch of idiots. I mean, let's be honest. The cut in rates was to create more inflation, to fill up the tax coffers, the hidden tax of inflation. Let's see what happened here. If we go back to September 18th with the first cut of 50 basis points, the 10-year notes were trading at 3.5%. Today, they're over 4.7%. With the Fed has cut 100 basis points. The rates to the borrower have gone up 120 basis points. So you tell me what that's all about. That's about creating more inflation and spending more money so that we can fill the government coffers with more tax dollars, because everything you buy has some sort of federal tax associated to it. So basically, the middle class got screwed by the Federal Reserve. How about all the people that have been laid off? Remember, they're using what is called the U3. Okay, which is a 3-month barometer of the jobs number. Okay, it doesn't count the people that just gave up and quit looking for jobs. They really need to use the U6. And if you looked at the U6, you would see a much different picture. I will bet any amount of money that this number will be revised next month. Okay, and jobs aren't coming back so fast because we don't have industry. We have a recession. Believe it or not, we have a recession, and nobody wants to admit to it. But when you walk around and you see, yes, people are spending money because they're putting on their charge card. Easy credit, big interest rates later. So, it's the old Fram oil filter. You can pay me now or you can pay me later. Well, people are choosing to try to pay it later, but they don't realize that they're paying somewhere between 27 and 29% interest, and that debt they're never going to get out. Okay, so that's the problem with what we've done here. And these jobs are not real. Okay, maybe they were temporary. Maybe they were jobs to help fix from the storms in North Carolina. Maybe they're, going to be now for the firefighters in California. But overall, good, real jobs are not available. And it's a bunch of garbage when they report that they are.
The current economic landscape presents both challenges and opportunities. Precious metals like gold, silver, and platinum are expected to perform well, with silver and platinum being undervalued compared to gold. Meanwhile, concerns over the over-leveraged banking sector and potential financial risks highlight the fragility of the current system. Todd Horwitz emphasizes the importance of preparing for long-term market corrections and the likely shift toward a gold-backed currency. As geopolitical and economic issues unfold, prioritizing domestic needs and reconsidering foreign aid could reshape U.S. policy. How could the return to a gold-backed currency impact the global financial system? What steps should investors take to protect their portfolios from the risks of an over-leveraged banking sector? Share your thoughts in the comments below. We'd love to hear from you. If you found this helpful video, don't forget to give it a thumbs up and subscribe for more content. Thanks for being a part of our journey.